Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Adding a new name to my portfolio, Sterling Infrastructure. Wanted to do a video on it quickly. This is an infrastructure name. Wanted to add an infrastructure name to my portfolio for quite some time. And this one got kind of interesting when it dropped into the low 100s not too long ago. I bought some shares, but this is a position I will build slowly because I feel like the valuation, at least versus historical norms, has gotten a bit stretched, even though on paper it looks very enticing with forward growth, with forward margin improvement, and what they're doing with the business. Again, 59% annual returns for the past 5 years. That is fantastic. Investors are very happy. The question is, what are the returns going to be on a go forward basis? A lot of these returns are driven by multiple expansion, so that always worries me a little bit because the multiple can contract pretty quickly. We are in a very bullish stock market. Multiples are expanding. Growth is still there, but when multiples are expanding at double the pace of growth, that always worries me as an investor, because what does that mean for long-term returns? If there's a significant market correction or even a small market corrections, a lot of these stocks could return to more historical multiples, and that means that Sterling potentially has quite a bit of downside, even though there's significant upside as well, given their growth potential and where their business is heading. So you can kind of see that 5-year average multiple at 12x. Right now it's trading close to the 20x on a normalized PE basis. So what does this business do? Well, they're an infrastructure provider in the United States. They have 3 business segments. 2023, almost half of their business is e-infrastructure solutions. That's the highest margin business. The reason they've grown so much is that their business has improved quite a bit. When you look at their historical results, EBIT margins have gone from 2.7% in 2017 all the way to 11.5% projected in 2024. In the last couple of years, they've almost doubled between 2020 and 2024. So that's kind of where the business is heading. It's improving margins. It's investing more in infrastructure solutions, which is kind of data centers, e-commerce buildings, etc., and then focusing less on some of these other businesses that are less margin accretive. So transportation solutions still a big part of their business. This is, roads, airports, railways, etc. And then building solutions, it's working with housing, commercial stuff, mainly laying down concrete is really what they do in their business. This is still a small company, a 3.8 billion market cap as of May 2024. Right now it's trading at around 3.4 billion, so down since this investor presentation was released. Their balance sheet is really solid. They've transformed their business since 2019, really focusing more on that high margin part of the business, the infrastructure solutions. You can kind of see their earnings and where they went from 2019 to 2023. Revenue growing at a 21% annual rate, EPS growing at a 38% annual rate. No surprise that their stock has done so well. Backlog is doing really well. These are the contracts that they have in place but haven't started yet. So over $2 billion worth of backlog there, and margins are improving on that backlog as well. And that backlog is continually growing, which is interesting. It started to slow a little bit right now as far as ending backlog goes. This is combined backlog, which means their total backlog plus unsigned but awarded contracts. It started slow a little bit because they've taken a different strategy in their e-infrastructure solutions business. They're focusing more on large mega projects versus small customer projects that are less high margin than those mega projects, and that's leading to maybe slowing growth in that segment, a lower backlog in that segment, but much higher margins, and we'll see that in their earnings. The question will be, can they return that segment back to growth with those higher margins? And that's really where the big question mark lies for this business. So that's something I'll see develop over the next couple of earnings releases as I follow this company. So what is the infrastructure business? E-infrastructure business. It's data centers, next-gen manufacturing, e-commerce distribution centers, large warehouses, etc. This is a big part of their business, high operating margins, and they're working with key customers like Meta, Amazon, etc. Obviously, when you listen to some of the earnings calls from these big tech players, they are investing a lot of money into AI. And AI is not just chips. It's building the data centers to house those chips, to house those servers, etc. And companies like Sterling help with that. It's, site selection, preparation, building, all of that stuff in various states. And they're seeing strong demand for those data centers, mega projects. A lot of stuff about reshoring manufacturing capacity, e-commerce distribution centers, etc. Obviously, the CHIPS Act with the massive semiconductor facilities that they're going to be building. There's a lot ahead for this company. And I think if you look at their backlog, they have pretty good visibility into what is ahead into 25, 26, and potentially even into 27, because a lot of these mega projects and even the smaller projects are in multi-steps in like a multi-phase thing. So they might have, hey, we're helping Meta work with site selection and preparation, but that's phase one, and it's only $5 million out of $100 million project. But we have an idea of what phase two is going to look like, and what phase three is going to look like, and what phase four is going to look like. And because we have that idea, because we're in for phase one, they believe they have a pretty good way to get into phase two and get into phase three and get into phase four. So that stuff isn't showing up in their backlog and isn't showing up in the results yet. But if they can get a contract for phase two and for phase three and for phase four, and they're probably more likely than somebody who's not involved in phase one, then that's good for their business and they feel pretty strongly about their growth potential. And you can kind of see the backlog here growing at a pretty decent clip, up 31% relative to the prior year. More focus on larger projects, more focus on better margins. Then you've got their transportation solutions business, about a third of their overall business. And this is, again, bridges, airports, ports, light rail, storm drainage systems in various states. This is a much lower operating margin business than e-infrastructure, but still a solid business for them, still a moneymaker. And this is something that's driven by state and local funding. Obviously, we need to improve our roads, we need to improve our airports, and the infrastructure bill has allocated a ton of money for that, billions and billions of dollars. Billions and billions of dollars for airports as well, a lot of funding for transportation projects in 22, 23, and this is a backlog that's growing very quickly and will probably continue to grow very quickly in the next couple of years. Again, when you talk about what are the two presidential candidates talking about, it's like, hey, we need to bring manufacturing back to the United States, we need to improve our roads, we need to invest in America. Well, this is investing in America. You're investing in something that's going to be involved in building the manufacturing capacity if it's needed in the United States, the data centers that are needed for AI to prosper, to do well, if that is going to do well. I mean, obviously companies are investing a ton of money into that. Whether or not it becomes a huge thing, the risk of not investing at all is probably greater than the risk of over-investing, as has been said by many on a lot of these tech earning calls. So that's going to benefit a company like Sterling, because the CapEx expenses that those companies are putting into these data centers are going to flow directly to a company like Sterling. And then the amount of money that's being invested via these infrastructure bills, the CHIPS Acts, et cetera, flowing to a company like Sterling. And then you've got also a business around building solutions, a low risk, low capex business where they get their cash pretty quickly. And this is a small part of their business, but decent operating margins, mainly in Texas and Arizona. And this is basically them putting down concrete slabs for residential and commercial properties, and also some plumbing capacities along with that. And I think this is a business that they can, add capacity to. They can add side additions to by acquisition. So, maybe plumbing, they'll do fixtures and things of that nature in other areas, and maybe they can expand this to other areas. And this is them working mainly with home builders like Pulte, D.R. Horton, and Leonard. So you can look at their financial overview. This is really where the business gets exciting and interesting. Cash flow is growing really quickly. 2023 is kind of an aberration because of timing of payments, but again, cash flow here is really solid. Their balance sheet has transformed itself. When you looked at this company in 2021, they had $500 million in debt and not a ton of cash. You look at it in 2024, they have $500 million in cash and much less debt. They are comfortable with looking at their debt at a 2.5x multiple to EBITDA, and right now it's right around 1.1x, so they can basically double their debt without an issue. They have the capacity to make acquisitions. They have made acquisitions. They are going to focus on organic growth, capex to support multi-year growth projects, weighing it towards e-infrastructure solutions, which is their highest margin business. Then they're going to make acquisitions, whether it's bolt-ons to improve their current business or fourth-like opportunities to kind of adjacent market exposure. Like, in 2021, they barely had an e-infrastructure business. In 2024, it's half of their business. So this is a management team that knows what they're doing, and they've done it well. On top of that, they feel like their stock is undervalued. They have a $200 million authorization for share repurchases, and they've been doing that quite a bit in the last couple of months, and I think that's going to continue to be the case. So this is kind of a growth opportunity, potentially stock buyback opportunity that is eventually going to potentially yield good returns for investors. So again, kind of a revisit of their business, their strategic transformation. You can kind of look at this. I'll link all this stuff down below in the description. You can kind of see where their operating margins have gone, some of the acquisitions they have made. And I think this is a business that's going to continue making acquisitions to expand their business, and they have the balance sheet to do so. If you look at their growth here, 12% growth quarter on a year-over-year basis, margins expanding. We is really good to see. E-infrastructure solutions, I kind of talked about this being a transition period. They're moving away from those smaller projects, so there's less projects, but they're bigger and higher in revenue per project in nature. Their backlog is still growing on this side, but at the end of the day, it's a year-over-year shrinkage for e-infrastructure solutions. But because of the focus on larger, higher margin projects, their margins are improving. However, I'll have to keep a close eye on this and make sure that e-infrastructure starts to grow again. Potentially not in Q3, but Q4, Q1 2025, that's really where the focus will be, because right now what's driving the growth is transportation solutions, which is their lowest margin business. That's a bit of a concern. If that continues to be the case, will margins start to be pressured because your lowest margin business is the one that's driving all of the growth. However, growth is still good. Margins at the end of the day are still improving because of the focus on mega cap projects, but I do have to see more results before I really make this a large position. Right now it's a sub 1% position for me. I'll build it out across time, but I want to kind of keep an eye on this business before I really grow it, because if you look at, again, their backlogs, their RPOs, it's really transportation solutions that's driving a lot of that growth, and that is primarily because of all of the investments in the infrastructure bill. But at the end of the day, they do have to get back to growth on this front, and it's going to mean bidding on a lot of those mega cap projects that are being worked on right now. Will they be involved in the Intel projects, et cetera? Stuff like that will really mean a lot for this business on the next 10-year horizon. However, this is still a very small business. A lot of opportunity for capital returns to investors, buying back stocks. I think the valuation is still very reasonable, even if the multiple is expanded. Their balance sheet looks really good. They can make acquisitions, and I think that's going to be the focus here from an investment perspective. Like, what are they doing as far as acquisitions go? Are they smart acquisitions? Where are they returning money to shareholders? I do not want a dividend as an investor. I want stock buybacks at this price point. So if you look at the valuation here, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. So valuation here, 3.4 billion. Balance sheet is really solid, negative debt. Right now, buybacks weren't really a thing in the last couple of years. They were working on shoring up their balance sheet. Now that the balance sheet is really good, they have that 200 million share repurchase plan in action. I'm putting 25% of their free cash flow towards buybacks. I think it could totally be higher. I think it would be 50, 75%. File, make a copy if you want to play around with this spreadsheet. But really what I'm putting in here is trying to be conservative about the assumptions and seeing where it gets me. As far as revenue growth goes, I think this is a company that could have 10% revenue growth for at least the next 5 years, but I'm being more conservative in terms of slowing growth here, a little bit more of a focus on that mega cap stuff. Mega project stuff means, hey, margins are going to improve, but growth is going to slow a bit, as we saw in Q2. Growth coming down a little bit, especially in the e-infrastructure space. However, I do want to see that e-infrastructure space return to growth by at least 2025, and we'll see how that looks in the next couple of earnings. So being conservative here, I think. If you disagree, let me know in the comments down below. Low single digit, mid single digit growth by 2028, margins in that 11.5% free cash flow range. Margins kind of follow EBIT in the last, historically, this kind of an aberration here. So I'm being more conservative for 2024 as far as cash flow goes. I'm kind of getting to a spot where I think it's a reasonable assumption for 2028. Buybacks are 25% of the cash. As far as valuation goes, again, I'm putting everything into the 6% free cash flow yield. When you look at this historically, you could certainly say, well, historically it's traded at 10%. So if that's your assumption here, the annual return with these assumptions is basically flat, not a good investment. However, this is a much different business than it was in 2021, 2020 when it was trading in that area. The margins are much better. The business is different. They have a much better balance sheet. So I think something in the 6% range seems reasonable. Again, it's trading in the 6.5% range on a forward basis and 11% range on the last 12-month basis, but that doesn't make any sense because this was a cash adjusted free cash flow based on timing of cash payments. So if I do that, get to an expected return of about 10%, not too bad. Kind of what you look for as an investor, about 10% returns. Obviously, the stock has had quite the run in the last couple of years, 50% plus returns annually. That's not going to be repeated. However, a 10% return seems relatively reasonable. And I feel like I'm being conservative here. They could certainly buy back more things. If you take the buyback to 50%, get close to 12% returns, a fair value about 123 bucks. At that 25%, the fair value is right around where it's trading right now, which makes sense to me. If you are looking for a higher target return, some margin of safety, maybe a 15% return gets you into the $90 range. I was a buyer in the $103 range when I started my position, kind of a 12.5% return from these assumptions. And I think these assumptions are relatively conservative. Like I said, I think they can probably grow at 10% for the next couple of years with the data center investment, with the infrastructure bills, with the CHIPS Act, et cetera. There's going to be plenty of work for these guys on the road side as well, on the building side as well. If interest rates come down, will that impact new home builders? Will home interest go up again? More buyers out there with lower interest rates means more houses being built, means more business in that area for a company like Sterling. Will they buy back more shares? They certainly could. There's probably going to be at least a couple of acquisitions here I'm not accounting for. Hopefully they're margin accretive, that they're improving margins, but they're at the very least going to improve revenue growth from an acquisition basis. So I think this is a conservative assumption. That's my take on it. If you're interested in infrastructure, this is a good way to play it. Certainly the risk here is that any type of recession will impact this business quite a bit. I think a lot of the fact that they're working with mega cap companies helps them because is Meta going to be impacted that much by a recession? Probably not as much as smaller companies. The reason they're not focusing on smaller projects right now is because those smaller companies are having a tough time in funding their projects with high interest rates. As those interest rates come down, if they come down, those projects might become more interesting again, yield higher margins. As interest rates come down, housing might become more interesting again, shoot off growth for a company like Sterling. And then investments in roads, etc., on the government side will probably continue, whether the stock market is doing well or poorly. But if a recession happens, will the multiple for a company like Sterling, even if growth is still okay-ish or shrinking just a little bit, be impacted? For sure, right? There's a reason the stock was trading as low as it was trading. Infrastructure can go out of favor pretty quickly. So am I making this a huge position right now? No, because the multiple is so far above its historical norm that it worries me a bit. But I think this is a much different company and it warrants it. However, if this stock were to continue dropping into the 90s, I'd build this position up quite a bit. 80s, 70s, this would be a significantly sized position for me, I think. But right now, it's just something I'm building slowly, hoping that it continues going up. But I wouldn't be very upset if it starts dropping a little bit because we've had a little bit of a bull market, and sometimes after that, the stock market corrects a little bit. And if it does, Sterling would be on top of my list to add to. If the valuation drops a little bit. So what do you think about Sterling? Are you interested in infrastructure at all? Let me know down below, leave a comment, etc. Like the video if you liked it. If you're new here, welcome to the channel. Again, this is a company that's not really followed by a lot of analysts. I think there's only 2 estimates out there for 24, 2 for 25, 1 for 26, none for 27 and 28. So a lot of opportunity here, I think, for an underfollowed company that could potentially grow faster than I'm assuming here with all of the investments that are being made in American infrastructure, because this is purely a play on American infrastructure. So if you believe in America A-OK, this might be an investment for you. It's certainly an investment for me, but always not investment advice, etc., etc., etc. Do your own due diligence, talk to a financial professional, etc. Thanks for watching. Bye.